My name is Tivashni, daughter of Raju, and my metric number is 01DAT23F1066. Today I will be presenting an overview of a crucial accounting standard, MFRS 16, leases, specifically focusing on its nature, definition and objective. This standard fundamentally changed how companies account for leases, so let's dive into what makes it so important. I will be explaining the nature, definition and objective of MFRS leases. The standard sets out the principles for recognizing, measuring, presenting and disclosing leases. It ensures both lessees and lessors provide accurate and relevant information about their lease transactions. The purpose is to help users to financial statements understand how lease affect a company's financial position, performance and cash flow. Entities must also consider all contract terms and apply the standard consistently to similar transactions. In short, MFRS leases ensures clear, consistent and reliable reporting of leasing activities.
Hi, Assalamualaikum. My name is Najwa Fatihah binti Hisham. My metric number is 01DAT2F1133. So now I will continue to explain the recognition of lessee under MFRS 16, which is the accounting standard that governs how lessee are recognized, measured, presented and disclosed in financial statement. So, the recognition of lessee. Under MFRS 16, a lessee is required to recognize a lease at the commencement date, which is the date when the lessor makes the underlying asset available for use. At that point, a lease must recognize two key items on the statement of financial position. The first one is right of use asset and the lease liability. This replaced the old operating lease model under MFRS 117, where lessee are mostly off balance sheet. Now, MFRS 16 brings almost all lessee into the balance sheet to reflect the true financial obligation of the lessee. The right of use asset represents the lessee right to use the leased asset throughout the lease term. So, the initial recognition amount of the right of use asset include the first one is the same amount as the lease liability. Second is adjustment for any lease payment made at or before commencement. Third is any initial direct cost incurred by the lessee, and the last one is estimated cost to dismantle, remove and restore the asset or site at the end of the lease. So, after initial recognition, the right of use asset is depreciated over the lease term or the useful life of the asset, whichever is shorter. If ownership transferred to the lessee at the end of lease, depreciation is over the useful life of the asset. So, this treatment ensures that the asset value is gradually reduced, similar to property, plant and equipment. So now is lease liability. The lease liability represents the lessee obligation to make a lease payment. The initial measurement of the lease liability is the present value of lease payment that are not yet paid at the commencement date. These payments are discounted using either the interest rate implicit in the lease, or if that is not available, the lessee incremental borrowing cost. Lease payment are generally include: first is fixed payment, including in substance fixed payment. Second is variable lease payment based on an index or rate. Third is amount expected to be payable under residual value guarantee. And the last one is the exercise price of a purchase option if it is reasonably certain the lessee will use it. After initial recognition, the lease liability is increased by interest expense and reduced by lease payment made. If there is a change in lease term or payment amount, the liability is remeasured and adjusted against the right of use asset. So now recognition for lessor. For the lessor, MFRS 16 requires classification of leases as either finance lease or operating lease. This classification depends on whether the risk and reward of ownership are transferred to the lessee. For finance lease, the finance lease transfers substantially all the risk and reward incidental to ownership of the asset to the lessee. In this case, the lessor recognized a variable equal to the net investment in the lease. So, this represents the present value of lease payment plus any unguaranteed residual value. Finance income is recognized over time, reflecting a constant periodic rate of return on the lessor net investment. So now for operating lease, if the lease does not transfer substantially or risk and reward of ownership, it is classified as an operating lease. The lessor keeps the asset on the balance sheet and recognize this income on a straight line basis or another systematic basis over the lease term. So this ensures income is recognized consistently throughout the period of the lease.
Assalamualaikum and hi, my name is Nur Kisina Idina binti Harun and my match number is 01D823F1127. And now I will present about measurement of leases under MFRS 16. Now, I will explain about initial measurement under paragraph 23, 24 and 26. Initial measurement of the right of use asset ROU asset. Under paragraph 23, at the commencement date, the lease shall measure at cost. And under paragraph 24, the cost of the right use asset shall comprise A. Amount of the initial measurement of the lease liability as described in paragraph 26. B. Any lease payments made at or before the commencement date less any lease incentive received. C. Any initial direct cost incurred by the lessee. And D. An estimate of costs to be incurred by the lessee in dismantling and removing the underlying asset. Restoring the site on which it is located or restoring the underlying asset to the conditions and condition of the lease unless those costs are incurred to produce inventories. Next, we move on to initial measurement of the lease liability under paragraph 26. At the commencement date, a lease shall measure the lease liability at the present value of the lease payments that are not paid at the date. The lease payment should be discounted using the interest rate implicit in the lease if that rate can be readily determined. The lease shall use the lease incremental borrowing rate. Now, we move on to subsequent measurement under paragraph 29, 30, 34, 35 and 36. For the first one is subsequent measurement of the right of use asset ROU asset. Under paragraph 29, after the commencement date, a leaser shall measure the right of use asset applying a cost model unless it applies either of the measurement models described in paragraph 34 and 35. Now we move on to under paragraph 30, which is cost model. To apply a cost model, a leaser shall measure the right of use asset at cost A. Less any accumulated depreciation and any accumulated impairment losses, and B. Adjusted any remeasurement of the lease liability specific in paragraph 38C. Now we move on to paragraph 34 and 35, which is other measurement models. If a leases use the fair value model under MFRS 140 for its investment property, the same model must also be used for any right of use asset that are also considered investment property. For paragraph 35, if a leases use the revaluation model under MFRS 116 for a certain type of property, plant and equipment, the leases may choose to apply the same revaluation model to all right of the use asset in the same asset class. Now, for the subsequent measurement of the lease liability under paragraph 36. Subsequent measurement of the lease liability by after the commencement date, a lease shall measure the lease liability. A. Increasing the carrying amount to reflect interest on the lease liability. B. Reducing the carrying amount to reflect the lease payment made. And C. Remeasuring the carrying amount to reflect any reassessment or lease modification specified in paragraph 39 until 46, or to reflect revised in substance fixed payments under paragraph B42.
Greeting to my lecturer and my fellow friends. My name is Ushantari Shankar and my metric number is 01D823F1044. I'm going to talk about presentation of lease under MRFS 16. Requires companies to present lease information clearly in their financial statement to show how lease affect assets, liability, income and cash. First of all is statement of profit or loss. Interest expenses on lease liability and depreciation of right of use assets ROU are presented separately. This separates financing costs from operating costs, giving a clearly picture of the impact of lease on profitability. Next is statement of financial position. Right of use asset ROU are shown separately from other assets. If not presented separately, they must be included in the same line as similar assets with disclosure explaining their inclusion. Third is lease liability. Lease liability are presented separately on the balance sheet. If not separate, notes must clarify which line items include lease liability. The last one is statement of cash flow. Principal portion of lease liability is known as financing activity. Interest portion is interest paid per MRFS 107. Short-term lease payment is operating activity. This clarification helps users to understand how lease payment affect the cash flow categories. Greeting to my lecturer and my fellow friends. My name is Ushantini Dr. Shankar and my metric number is 018823F1044. Today I'm going to presenting about disclosure of lease under MRFS 6. So the objective of disclosure is financial position. Disclosure shows how lease affect the assets and liability of an entity. For example, recognition of right of use asset and lease liability in the statement of financial positions. Users can understand the company's obligation and ownership rights from leased. Next is financial performance. It explains how lease influence the profit or loss of the company. It involves reporting lease expenses, interest on lease liability and depreciation of ROU asset in the statement of profit or loss. This helps stockholders assess how leasing impacts profitability and performance metrics. Lastly is disclosure information in the notes provides details explanation of lease terms, assumptions and other relevant data not visible directly on the face of financial statement. Note include detail like lease term and condition, variable lease payment, maturity analysis of lease liability, and last is accounting policies for lease. Next is format of SOFP, which is known as Statement of Financial Position, is separate section. Lease assets and liabilities are shown as separate line items on the balance sheet. Example, ROU assets under non-current asset, lease liability under current and non-current liability. This format increases transparency by clearly distinguishing lease-related item from other assets and liability. Next is disclosure in a single note. Instead of separate line items, the lease-related figures are disclosed within the notes to financial statement. This approach is suitable for entities where lease liability are not material or less significant. The note explains the composition of lease assets and liability with proper cross-reference. Key importance of disclosure under MRFS 16. The disclosure of lease information under MRFS 16 is crucial because it allows users of financial statement to understand how leases affect a company's financial position, performance and cash flow. It provides transparency and helps in making better investment and management decisions. The first key is depreciation charge for the right of use ROU asset. It shows how much of the right of use asset's value is consumed during the period and helps the users to access the useful life and future value of leased assets. Next is interest expenses is to reflect the finance cost from lease liability and important for understanding the total cost of financing through leases. Third is expenses relating to short-term lease is discloses cost for lease with terms less than 12 months and indicates how much the companies release on temporary or flexible leasing agreements. Next is expenses relating to lease of low value asset. It shows cost for leasing items like small office equipment or furniture and help the user to evaluate how minor lease commitments affect overall expenses. The fifth is expenses relating to variable lease payment is not included in measurement of lease liability. It represents payments that vary based on usage or performance, and it's important for understanding potential future cash flow that are not fixed. The sixth is income from subleasing right of use assets, which is disclosed revenue earned when lease assets are subleased to others and demonstrate how efficiently the company utilizes lease resources. The seventh is total cash flows for lease, summarize all payment made for leases during the year and help access the company's liquidity and cash flow management. The eighth is addition to right of use assets is represents new or modification acts during the period and indicate growth or changes in the company's leasing activity. The next is gain or loss from sales and leaseback transaction arise when an asset is sold and immediately leased back, and it shows how such transaction affect profit and cash flow. The last is current asset of right of use asset ROU identifies the portion of the right of use asset expected to be realized with 1 year and useful for short-term assets management and liquidity analysis. That's all from me. Thank you.